There's a photograph from 1923 Weimar Germany that tells you everything you need to know about what happens when money dies. A woman is feeding her tile stove with bundles of German marks because the currency is cheaper than firewood. Children are building blocks with stacks of worthless banknotes. And a wheelbarrow full of cash, millions of marks, sits on a street corner, stolen not for the money but for the wheelbarrow, which has more value than the currency it carried. This is where monetary policy ends when governments lose all restraint, when the printing presses run continuously, when the link between currency and any economic reality is severed completely. The stories you're about to hear aren't ancient history or irrelevant cautionary tales from primitive economies that couldn't manage their finances. They're recent. Venezuela collapsed within the last decade. Zimbabwe's currency died in the 2000s. Argentina has experienced multiple currency crises in living memory. And the pattern is always the same. Governments that can't or won't control spending print money to cover deficits, inflation accelerates into hyperinflation, the currency becomes worthless, savings are destroyed, and society fractures as the medium of exchange that held it together disintegrates. Understanding when money dies means recognizing that every fiat currency in history has eventually failed, that the US dollar and euro and pound are experiments barely 50 years old with no guarantee of success, and that the conditions that destroyed previous currencies, unsustainable government debt, political unwillingness to make hard choices, central banks that monetize deficits, are present in developed economies today at scales that dwarf historical examples. The question isn't whether currency collapse can happen in modern developed nations. History proves it can and repeatedly has. The question is what you do when it starts, how you recognize the warning signs before it's too late, and whether you'll be among the few who preserve wealth or the many who lose everything. Weimar Germany's hyperinflation remains the most studied currency collapse in history because of its scale, its documentation, and its political consequences. In 1914, before World War I, the German mark traded at 4.2 to the US dollar. By November 1923, the exchange rate was 4.2 trillion marks to $1. A single gold mark from 1914 could buy 1 trillion paper marks by 1923's end. This wasn't gradual. The acceleration was exponential. Prices that doubled monthly in early 1923 were doubling daily by October, then hourly at the peak. A cup of coffee consumed at a cafe would cost more by the time you finished it than when you ordered it. Workers demanded payment twice daily so they could spend money before it lost more value. And the psychological destruction matched the economic devastation as life savings, pensions, insurance policies, and bonds became worthless paper. The causes of Weimar hyperinflation are disputed among historians, but the mechanism is clear. Germany emerged from World War I with enormous reparations obligations imposed by the Treaty of Versailles, domestic debt from war financing, and an economy devastated by years of conflict. The government faced impossible fiscal constraints. It couldn't raise taxes enough to cover spending without causing revolt, and it couldn't cut spending without causing economic collapse and political instability. The solution was to print money. The Reichsbank monetized government deficits by buying treasury bills with newly created marks, expanding the currency supply exponentially. As more marks entered circulation, each mark became worth less, requiring even more marks to finance the same real level of government spending, creating a death spiral where deficit monetization caused inflation that required more monetization that caused more inflation. German officials didn't believe they were causing inflation through money printing. They argued that inflation was caused by reparations payments, by currency speculation, by balance of payments problems, anything but monetary expansion. The Reichsbank president maintained that the currency supply was responding to prices rather than causing them, that the bank was simply providing the currency the economy needed. This denial of monetary economics' basic principles wasn't ignorance, it was politically motivated rejection of the truth because acknowledging that money printing caused inflation would require stopping the printing, which would force government to make spending cuts or raise taxes that were politically impossible. So they continued printing and claiming it wasn't the cause until the currency was destroyed. The human cost was catastrophic. The middle class was wiped out. Anyone who'd saved in marks, held bonds, owned fixed income securities, or maintained life insurance policies lost everything. A lifetime of prudent saving became worthless. Pensioners who'd worked 40 years for retirement income found their pensions bought nothing. War widows receiving fixed government payments starved as those payments became valueless. The only people who survived financially were those who'd converted to foreign currency, gold, or real assets before the collapse, and those who held debt that they could repay with worthless currency. Borrowers profited enormously. anyone with a mortgage could pay it off with nearly worthless marks, acquiring homes essentially for free. Industrialists who'd borrowed to build factories repaid debts that were reduced to nothing in real terms, emerging from the hyperinflation as owners of valuable real assets bought with money that no longer existed. And speculators who understood what was happening bought foreign currency and real estate, watching their wealth multiply as mark-denominated prices soared. The hyperinflation was the greatest wealth transfer in German history, from savers to borrowers, from the prudent middle class to speculators and debtors, from those on fixed incomes to those who understood inflation and positioned accordingly. The political consequences were even worse than the economic devastation. The destruction of middle-class savings created a generation of Germans who'd lost faith in traditional institutions, in capitalism, in democracy, in the social contract that said hard work and saving would be rewarded. This social disruption contributed directly to political extremism and eventually to the rise of the Nazi Party, which exploited the grievances and fears of those who'd been economically destroyed. The hyperinflation didn't single-handedly cause World War II, but it created conditions that made Hitler's rise possible. Currency collapse doesn't just destroy wealth, it destroys social cohesion and political stability, creating the conditions for extremism and violence. Hungary after World War II experienced even worse hyperinflation than Weimar, though it's less famous because it was shorter and less documented. From August 1945 to July 1946, Hungarian prices doubled every 15 hours at the peak. The largest denomination note was 100 quintillion pengu, a number so large it's effectively meaningless. A pengu that could buy a house in 1945 couldn't buy a postage stamp by mid-1946. The government finally introduced a new currency, the forint, at an exchange rate of 400 octillion pengu to 1 forint. Every person's life savings in pengu became worth roughly nothing when converted to the new currency. The Hungarian case demonstrates that hyperinflation can accelerate beyond anything imaginable. Once the process starts and confidence breaks, velocity of money, how fast people spend currency to avoid holding it, increases dramatically. This acceleration itself causes further inflation in a feedback loop that can spiral completely out of control in weeks rather than years. Hungary's hyperinflation shows that when currency dies, it can die very quickly, giving holders almost no time to escape before their savings are destroyed. Yugoslavia in the 1990s provides a more recent example, demonstrating that currency collapse isn't limited to post-war reconstruction periods. Yugoslavia's breakup and the wars that followed created fiscal crises that the government financed through money printing. By 1993, inflation reached 313 million% annually. A 500 billion dinar note was introduced, the largest denomination ever printed at that time. The currency was redenominated multiple times, removing zeros to make calculations possible, but each redenomination failed to stop the inflation because the underlying cause, deficit monetization, continued. Eventually, the dinar became completely worthless and was abandoned in favor of the German mark and later the euro in different Yugoslav successor states. Zimbabwe's currency collapse in the 2000s is the most recent pure hyperinflation and provides the clearest lessons because it's well documented and occurred in the modern era. Zimbabwe was relatively prosperous at independence in 1980, called the breadbasket of Africa, with productive farms and functioning institutions. But President Robert Mugabe's policies, particularly land reforms that seized commercial farms from white farmers and redistributed them to political supporters without agricultural expertise, destroyed agricultural production. Government revenue collapsed as the tax base evaporated, but spending continued and accelerated as Mugabe used patronage spending to maintain political control. The Reserve Bank of Zimbabwe financed government deficits by printing money, expanding the currency supply at rates that beggar imagination. Inflation reached 79.6 billion% in mid-2008, meaning prices doubled every 24 hours. The central bank issued a $100 trillion note, the largest denomination ever printed. But even that massive note couldn't buy basic groceries within weeks of issue. By 2009, the Zimbabwe dollar was abandoned completely in favor of the US dollar, South African rand, and other foreign currencies that people actually trusted. The human consequences in Zimbabwe were devastating. Savings were completely destroyed. Anyone who held Zimbabwe dollars, had money in bank accounts, or owned government bonds lost everything. Pensions became worthless. Salaries couldn't keep pace with daily price increases. People resorted to barter and foreign currency transactions. The formal economy largely collapsed, replaced by black markets and informal trade. and millions fled the country, creating a refugee crisis and brain drain as anyone with skills or means sought safety in neighboring countries. But what's most revealing about Zimbabwe is who benefited. Political elites who had access to foreign currency and hard assets maintained or increased their wealth. Those connected to the government received preferential exchange rates for foreign currency, allowing them to buy Zimbabwe dollars at official rates far below black market rates, then use those dollars to purchase real assets at deflated prices. The Reserve Bank of Zimbabwe, which created the hyperinflation, profited from it through seigniorage, the profit from creating currency, and through foreign currency operations that enriched bank officials and connected elites. The currency collapse was a wealth transfer from the general population to those closest to political and monetary power. Venezuela's ongoing currency collapse demonstrates that hyperinflation isn't just a historical phenomenon, but continues in the modern world despite all our supposed economic sophistication. Venezuela in the 1970s was Latin America's richest country with the world's largest oil reserves and substantial foreign currency reserves. But decades of socialist policies, government spending financed by oil revenues, and particularly the Chavez and Maduro regimes' economic mismanagement destroyed the productive economy. When oil prices fell in 2014, government revenues collapsed, but spending continued, financed increasingly by the central bank printing bolivars to buy government debt. By 2018, Venezuela's inflation exceeded 1,000,000% annually. The bolivar was redenominated multiple times, removing 5 zeros in 2008, 3 zeros in 2018, and 6 more zeros in 2021. But removing zeros doesn't stop inflation when the underlying cause, monetary financing of deficits, continues. The bolivar became essentially worthless, replaced in practice by the US dollar for any significant transactions. A country with enormous natural resource wealth descended into poverty as currency collapse destroyed savings, made economic calculation impossible, and caused the formal economy to cease functioning. The human cost in Venezuela included mass starvation, medical shortages because hospitals couldn't buy supplies, and emigration of over 7 million people, nearly a quarter of the population. Those who stayed faced daily struggles to find food, medicine, and basic necessities. Wages couldn't keep pace with price increases. Pensions and social security became worthless. And crime exploded as desperate people turned to theft and violence to survive. This happened not in the distant past or in a war-torn nation, but in a country that had been prosperous within living memory, demonstrating how quickly currency collapse can destroy society. Argentina provides a different lesson, showing that countries can experience repeated currency crises without learning from them. Argentina has experienced 5 currency collapses in the past century, in 1930, 1951, 1976, 1981, and 2001, with chronic high inflation between crises. Each crisis destroyed savings and required currency redenomination. The peso ley replaced the peso moneda nacional in 1970. The peso argentino replaced the peso ley in 1983. The austral replaced the peso argentino in 1985. The current peso replaced the austral in 1992. Each replacement removed zeros and promised stability. Each eventually failed as government spending exceeded revenues and the central bank monetized deficits. Argentina's pattern demonstrates that currency collapse becomes easier and more likely each time it happens. Once a society experiences hyperinflation, trust in the currency never fully recovers. People become inflation sensitive, converting to dollars or hard assets at the first sign of trouble. This inflation sensitivity means that even moderate inflation can quickly accelerate if confidence breaks. And political systems that failed to maintain fiscal discipline once are unlikely to do so in the future, especially when money printing offers a politically easier solution than spending cuts or tax increases. The lessons from these currency collapses are consistent across time and geography. First, currency collapse is always preceded by unsustainable government fiscal policy. No country experiences hyperinflation without large government deficits that are monetized by central banks creating money to buy government debt. The specific cause of fiscal stress varies: war reparations in Weimar, war costs in Hungary, political patronage in Zimbabwe, socialist spending in Venezuela, but the pattern is always the same. Government spending exceeds revenues, borrowing from private markets becomes impossible or insufficient, and money printing fills the gap. Second, officials always deny that money printing causes inflation until it's too late. The Reichsbank in Weimar, the Reserve Bank of Zimbabwe, the Central Bank of Venezuela, all maintained while printing money exponentially that inflation had other causes. Reparations, sanctions, speculation, supply problems, anything but monetary expansion. This denial isn't stupidity, it's political necessity. Admitting that money printing causes inflation requires stopping the printing, which requires cutting spending or raising taxes, which officials can't or won't do. So they deny monetary economics' basic principles and continue printing until the currency dies. Third, the acceleration from moderate inflation to hyperinflation happens faster than anyone expects. Venezuela had moderate inflation around 20-30% annually for years before it suddenly exploded to 700% in 2016, then 2600% in 2017, then over 1,000,000% in 2018. The acceleration is exponential because inflation destroys confidence in currency, which increases velocity as people spend money faster to avoid holding it, which causes more inflation, which destroys confidence further. Once this feedback loop starts, it's almost impossible to stop without radical reforms. Fourth, the middle class is always destroyed while political and economic elites often prosper. Those holding currency, bonds, pensions, insurance policies, anything denominated in the dying currency, lose everything. But those with access to foreign currency, hard assets, and political connections can profit enormously by buying real assets with rapidly depreciating currency or by exploiting their positions to access foreign currency at preferential rates. Hyperinflation is the most regressive possible economic policy, destroying the savings and security of ordinary people while concentrating wealth among the politically connected and financially sophisticated. Fifth, the political and social consequences often exceed the economic damage. Germany's hyperinflation contributed to the rise of Nazism. Zimbabwe's created a refugee crisis and destroyed regional stability. Venezuela's caused one of the largest refugee movements in Western Hemisphere history. Currency collapse doesn't just make people poor, it destroys trust in institutions, in capitalism, in democracy, in the social contract. The extremism and instability that follows can last for generations. Sixth, recovery requires not just currency reform, but fundamental changes to fiscal and monetary institutions that prevent repetition, countries that simply introduce new currencies without addressing underlying fiscal problems like Argentina experience repeated collapses. Those that couple currency reform with fiscal discipline and often external constraints like currency boards or adoption of foreign currency can achieve stability. But recovery takes decades as social trust and institutional credibility slowly rebuild. The question every holder of fiat currency should ask is whether current policies in developed economies look more like the stable monetary systems that prevented inflation, or like the policies that preceded historical collapses. The U.S. federal debt exceeds $6 trillion and grows by over $1 trillion annually. The Federal Reserve's balance sheet expanded from under $1 trillion before 2008 to over $9 trillion at its peak. Direct monetization of government debt through quantitative easing. Japan's government debt exceeds 250% of GDP, the highest level of any developed country, sustained only by Bank of Japan purchases of government bonds. The European Central Bank has purchased trillions in member government bonds despite treaties supposedly prohibiting monetary financing of government debt. These policies look alarmingly like the early stages of deficit monetization that preceded historical collapses. The scale is different, orders of magnitude larger than Weimar or Zimbabwe. But the mechanism is identical. Unsustainable government spending financed by central banks creating money to buy government debt. The main argument that developed economies won't experience currency collapse is that central banks will stop monetizing deficits before inflation gets out of control. But this assumes political will to make painful choices that has been absent in every historical example. When the choice comes between accepting currency collapse and making the spending cuts or tax increases necessary to prevent it, every government in history has chosen to keep printing until the currency died. The warning signs of impending currency crisis are recognizable once you know what to look for. Rapidly growing government debt-to-GDP ratios indicate unsustainable fiscal policy. Central bank purchases of government debt suggest monetary financing. Real interest rates, nominal rates, minus inflation, below zero indicate savers are losing purchasing power and capital is being destroyed. Widening spreads between official exchange rates and black market rates show people are trying to escape the currency. Shortages of goods as businesses can't function with unstable currency or as people hoard anticipating price increases. and capital flight as those with means move wealth to foreign currencies or assets outside the country. All these warning signs exist today in various forms across developed economies. Real interest rates have been negative for extended periods as inflation exceeded nominal interest rates. Capital has flowed consistently toward hard assets like real estate and stocks, driving valuations to historic highs disconnected from economic fundamentals. Shortages during the pandemic revealed supply chain fragilities and governments' willingness to print unlimited money. And wealth is increasingly held offshore or in alternative assets as trust in traditional banking and currency declines. The response to these warning signs determines who survives currency collapse with wealth intact and who loses everything. Historical examples show that those who preserved wealth shared certain strategies. They converted currency to hard assets like real estate, precious metals, or productive businesses that retain value regardless of currency. They acquired foreign currency, holding dollars, Swiss francs, or other relatively stable currencies instead of domestic currency. They held physical commodities or investments tied to commodity prices that rise with inflation. They borrowed in doomed currency and bought assets, letting inflation destroy the debt's real value while the assets appreciated nominally. And they positioned themselves to leave, maintaining foreign residency options or moving wealth abroad so collapse wouldn't trap them. Those who lost everything shared different characteristics. They trusted officials who insisted the currency was sound and inflation was temporary. They held savings in bank accounts, bonds, or fixed income securities denominated in dying currency. They maintained mortgages or debts in foreign currency or inflation-indexed terms that became impossible to service as local currency collapsed. They didn't have foreign currency reserves or hard assets, and they had no plan or ability to leave, making them captive to the collapse. The psychologically hardest aspect of preparing for currency collapse is that you have to act before it's obvious to everyone. By the time hyperinflation is undeniable, it's too late. Exchange controls have been imposed, preventing conversion to foreign currency. Asset prices have soared beyond affordability. Emigration becomes difficult or impossible. You have to recognize the signs early and act while being called alarmist, while officials insist everything is fine, while most people think you're crazy for not trusting the currency. The penalty for being wrong is missing out on investment returns. The penalty for being right but acting too late is losing everything. This creates an asymmetric risk calculation. If you prepare for currency collapse that doesn't happen, you've held some wealth in lower returning safe assets and perhaps paid some costs for foreign currency exposure or physical metal storage. If you don't prepare and collapse happens, you lose everything. The rational response to even a small probability of currency collapse is to take substantial precautions because the downside is so catastrophic. But human psychology works against this. We're wired to trust authority, to assume tomorrow will be like today, and to follow the crowd rather than prepare for low probability but high impact events. The final lesson from currencies that collapsed is that it can happen anywhere to anyone. Weimar Germany was one of the world's most advanced economies with sophisticated financial institutions. Argentina was one of the world's richest countries in the early 20th century. Zimbabwe was prosperous at independence. Venezuela had the world's largest oil reserves and was Latin America's wealthiest nation. Prosperity, resources, and sophistication provide no protection against currency collapse if fiscal and monetary policy is unsustainable. The United States, Europe, and Japan have advantages like reserve currency status, deep financial markets, and institutional credibility. But these advantages can evaporate quickly if policies continue on unsustainable paths and if confidence breaks. Currency is ultimately based on confidence, on collective agreement that pieces of paper or electronic entries have value. When that confidence breaks, for whatever reason, the currency can collapse with shocking speed regardless of prior stability. The mark was stable for decades before 1914. The bolivar was stable for generations before 2014. Stability can breed complacency, leading people to assume the currency will always be accepted and will always hold value. But history shows that no fiat currency lasts forever. The average lifespan of a fiat currency is 27 years. The dollar has been pure fiat only since 1971, barely 50 years. The euro has existed less than 25 years. These are experiments in progress, not proven systems that will last indefinitely. Understanding when money dies means recognizing that currency collapse is not ancient history or irrelevant to modern developed economies. It's a recurring event that happens when governments lose fiscal discipline and central banks monetize deficits. It's happening now in various forms in countries around the world. and the conditions that caused it historically exist today in developed economies at scales that would have been unimaginable to previous generations. The printing presses, now computers that create money electronically, are running, the debt is accelerating, the fiscal constraints are impossible, and the political will to make hard choices is absent. The question isn't whether currency collapse can happen in America or Europe or Japan. History proves it can happen anywhere that policies are unsustainable. The question is what you'll do when it starts, whether you'll recognize the signs in time, whether you'll have the courage to act while others call you alarmist, and whether you'll be among the few who preserve wealth or the many who watch helplessly as their life savings become worthless paper. When money dies, it dies for everyone holding it. The time to prepare isn't when the collapse is obvious, but before it starts, when you can still convert to safety at reasonable prices, when capital controls haven't been imposed, when the exits are still open. That time is now. While most people still trust the currency, while officials still insist everything is fine, while acting looks like paranoia rather than prudence, history doesn't repeat, but currency collapses always do. And every person who lost everything in previous collapses thought it couldn't happen to them, trusted their government, believed their currency was different, and waited until it was too late to act. Don't be them. If this gave you a new perspective, hit subscribe. History is screaming its lessons about what happens when money dies, when governments print without limit, when debt becomes unpayable and currency becomes confetti. Every collapsed currency in history looked stable until it didn't. Every government that printed to hyperinflation insisted it wouldn't happen until it did. Every saver who lost everything thought they were being prudent and responsible until their prudence became poverty. The lessons are clear, the warning signs are present. The question is whether you'll learn from history or repeat it, whether you'll prepare while there's time or realize too late that the currency you trusted was just paper and promises from people who'd made the same promises to every generation that watched their money die. The collapse isn't coming. It's already started. You just haven't realized it yet because it happens slowly at first, then all at once. And by the time everyone sees it clearly, the wheelbarrows are full of worthless cash, the children are playing with currency blocks, and the only question left is whether you positioned yourself to survive or joined the millions who learned too late. That when money dies, it takes your savings, your security, and your future with it.